Ladies and gentlemen, thank you once again for joining me. In the last video, we did discuss value investing, and now we shall consider growth investing. In the late 1990s, when technology companies flourished, growth investing techniques yielded unprecedented returns for those who had invested. However, before any investor gets on board with growth investing and the growth investing bandwagon, they should understand that this strategy comes with substantial risks and obviously is not for everyone. The best way for me to define growth investing is by comparing it to value investing. The value investors are solely concerned with the here and now. They try to find stocks that are trading below their intrinsic worth. Growth investors, on the other hand, zero in on future worth of a business, with substantially less emphasis on the current price. Growth investors, unlike value investors, purchases businesses that are trading above company's current intrinsic worth. This is, however, done in the hopes that the company's intrinsic worth will increase and exceed their current valuations. As the name implies, growth stocks are businesses that are positioned to grow much faster than others. Because of this, growth investors are primarily interested in fledgling or beginning companies. The idea or hope is that an increase in revenues and/or earnings will directly translate into a boost in stock price. Usually, a growth investor searches for investments in industries that are expanding at a rapid pace. Those related to any new technology are prime candidates. Profit occurs through capital gains and not dividends. This is because almost every growth company reinvests their earnings and doesn't pay out dividends. As mentioned, growth investors are indeed interested in the future growth potential of any given business, but there's really no cut-and-dry calculation for gauging this. Each method of choosing growth stocks, or any type of stock for that matter, requires individual interpretation and judgment. It's up to you. Growth investors use certain methods as the skeleton structure for their analysis, but these strategies have to be used with a given company's specific situation in mind. To clarify, the investor absolutely must think about the company relative to its past performance and the performance of the entire industry it's located within. The application of any one guideline may fluctuate from business to business and within separate industries. Now, the NAIC, which is the National Association of Investors Corporation, is one of the most popular associations teaching and putting into application growth investing tactics. It blatantly says on their site that they are one big investment club, whose goal is educating investors how to wisely invest. The NAIC created some universally used trends for identifying possible growth companies. These are some questions the NAIC recommends asking during your stock picking decision-making process. The NAIC says the first inquiry should be whether the company has been growing in the past. This is based on annual revenue, of course. Here are some simple guidelines for the EPS growth that an investor keeps their eyes peeled for in companies, big and small, that indicates their growth investing potential. Though what is shown in a 5-year period, many argue that a 10-year span with growth like this is even more attractive. The fundamental idea is that if a company shows good growth over the last 5 to 10 years, it will probably continue during the next 5 to 10 years. The second criterion set out by the NAIC is a projected 5-year growth rate of at least 10 to 12%, although obviously 15% is far better. Anything more than that might be ideal, but we're getting into fantasy land, so let's bring it back here for a moment. You can use projections that are made by analysts, the company, or other credible sources, or as long as you get better at this, you can do it yourself. As you have probably determined by now, the big problem with forward estimates is that they are just that, they are estimates. When a growth investor sees an ideal projection of growth, they must evaluate its credibility prior to blindly trusting it. You start this evaluation with a knowledge of the typical growth rates for different sizes of companies. For example, an established large corporation will not be able to grow as quickly as a younger, small capital tech company. It just isn't going to happen. Also, when checking the consensus estimates of analysts, an investor ought to be familiar with the industry of the business. In other words, what is the prospects and what its prospects are and where the company is in its current stage of growth. The third guideline set out by the NAIC solely concerns themselves with pre-tax profit margins. There are countless examples of businesses with outstanding sales growth, but less than outstanding earnings gains. High annual revenue growth is all well and good, but if the EPS has not risen to the same rate or at the same rate, which is a proportional rate, it is probably because of a downturn in profit margin. By comparing a business's current profit margins to its previous or historic margins, as well as the profit margins of its competitors, a growth investor is able to accurately appraise whether or not management is properly controlling cost and revenues, and also effectively maintaining the margins. A general guideline is that if a company surpasses its prior 5-year average of pre-tax profit margins in addition to those in its industry, the company could indeed be a decent candidate for growth. Efficiency can't be quantified using the return on equity, which is the ROE factor. Efficient use of assets is generally reflected in a stable or upswinging ROE. Once more, analysis of this method for measuring should be relative. A business's current ROE is contrasted to the best 5-year average ROE of the business and its industry. So, if you're interested in growth investing, here's a sound model you can use. If it is not realistic for the stock to double in 5 years, it's likely not a growth stock. This may seem like an unreasonable standard, but keep in mind that with growth rates like 10%, a stock price would double in 7 years. So the rate investors are looking to see is 15% per year or per annum, which yields a doubling in price in 5 years. So, now that we've outlined the NAIC's basic criteria for evaluating growth stocks, I'll give you some examples of how these stipulations are used to analyze a company. For the sake of this demonstration, I'll treat these numbers as though they were any given business's most current numbers. When you do this yourself, try and use the most current data you can find. Both of these are strong figures. The annual EPS growth is substantially higher than the 5% norm the NAIC lays out for these sized firms. The projected growth figures are fairly sturdy, but nothing really that special. Now, there are two different ways to view this. The trend is down about 5%, from 50% to 46%, from the 5-year average, and that's negative. Remember, the industry's average margin is only 27%, so even though this company's margins have dropped, they're still a whole lot higher than those of its industry. Investors should be a bit concerned that ROE figures are slightly less than the 5-year average, but the ROE is not dramatically reduced. It's only down a few points and still well above the industry average. So, is this a growth stock? On paper, this company meets many of the NAIC's criteria for a growth stock, but it also falls short in others. If, for instance, we were to dismiss this company because of its decreased margins and not compare them to the margins of the industry, we wouldn't be factoring in the industry conditions that this company operates within. If we do indeed compare it to the industry, we still need to gauge how suggestive it is that this company has higher than average margins. Is this a good growth stock, even with its maturing industry and dropping margins? Is it possible for a company this size to continue discovering enough fresh markets to keep expanding? These are the questions you should be asking yourself when considering growth stocks. Now, and I should mention, there are good arguments on both sides, and understandably so, there is no one right or one correct answer. What these criteria do, however, is open up pathways of analysis through which we can dig deeper into the current state of the business. Being that no one set of criteria is perfect, as the growth investor continues to learn that they may want to adjust a set of guidelines by adding or omitting certain criteria. So, though I've provided those 5 fundamental questions, it's vital to keep in mind that the purpose of this example was to provide a starting point from which you can conduct your own growth analysis. Finally and lastly, I want to assure you that it's not too complicated. Growth investors are interested in growth. It's very simple. The fundamental idea of growth investing is to discover companies that continuously reinvest in themselves to create new goods, services, and technology. Even though the stocks might be expensive at this very moment, growth investors believe that expanding top and bottom lines will guarantee that an investment pays off in the long term. We hope you found this video helpful and have expanded your knowledge of this kind of thing. You too can invest knowledgeably. These videos are designed to help you build your investing knowledge and skills, develop and understand your personal investment goals, and develop a written plan in light of those goals. Use the knowledge you gain from these videos to help you choose investments carefully and prudently that serve your stated plan. And again, have fun doing it. Investing, like I said, can provide a very satisfying way to control your own financial destiny. It is the ultimate interactive and instructive game. It can be a hobby or a lifelong passion. Enjoy the process.